Japan has lent the United States $1.24 trillion. That is $10,131 from every man, woman and child in Japan, sitting inside American government debt. For 30 years, that money was the cheapest on Earth. The whole world borrowed it. This year, Japan started taking it back. So what breaks first? To see why that matters, you have to look at the last time this cracked. On the 31st of July 2024, the Bank of Japan raised its interest rate. Not by much, from 0.1% to 0.25, 15 hundredths of 1 percentage point. 3 days later, Monday the 5th of August, the Tokyo stock market fell 12.4% in a single session, its worst day since 1987. And it did not stay in Tokyo. By the time New York opened, the S&P 500 was down 3%, the Nasdaq 3.4%. The Dow shed more than 1,000 points in a day. According to CNBC, Wall Street's fear gauge hit its highest level since the first weeks of the pandemic. Bloomberg counted $6.4 trillion, wiped off global stocks in the 3 weeks into that Monday. Now, here is the strange part. Nothing had gone wrong in America. No bank had failed. No great company had missed its numbers. The trigger was a committee in Tokyo, moving a number by what looks like a rounding error. So how does 15 hundredths of 1% do that? It doesn't. Not on its own. It did it because of what that number was quietly holding up. And to see that, you need to understand the single largest borrowing arrangement in the world, one that almost nobody voted for and almost nobody can measure. Here is the whole thing, and it is simpler than it sounds. Japan lends money at 1%. America lends at about 3.5%, so you borrow $1 million worth of yen. In Tokyo, you change it into dollars. You park it in America. You pay Tokyo 1%. America pays you 3.5%. You keep the difference, about $26,000 a year, for doing nothing at all. That's it. Borrow where money is cheap. Park it where money is dear. Pocket the gap. And for 30 years it worked. The profits went into American technology stocks, into property, into bonds in India, Indonesia and Thailand. Somewhere between $300 and $500 billion of it, by street estimates. 2 things about this make it dangerous. First, almost none of it is done with your own money. Traders borrow, then borrow again on top. A small move against them doesn't dent the profit, it starts eating the loan. Second, the whole arrangement rests on the yen staying weak. You borrowed in yen. One day you pay it back in yen. If the yen suddenly gets more expensive, your debt grows while you sleep. So, how big is this? Nobody knows. And I want to be careful here because that is not me dodging. It is the actual state of the evidence. The lowest serious estimate from the Bank for International Settlements is around $4 trillion. The highest estimates run to 20. To put that in something you can picture, the low guess is roughly the size of Japan's entire economy. The high guess is roughly the size of China's. The reason nobody can narrow it is that most of these positions aren't loans sitting on a bank's books. They're private side deals on the currency. Arrangements between 2 firms that no one is required to publish. The world's regulators genuinely cannot tell you how much of this exists. Earlier this year, the research house BCA called it, in their words, a ticking time bomb. You cannot manage a fire when nobody will say how much fuel is in the building. For 30 years, that machine ran in one direction. In 2023, something broke. Up until 2023, this was almost mechanical. If you knew the gap between American and Japanese interest rates, you could explain about 90% of where the yen went. Rates moved, the currency followed, then it stopped working. Since then, that gap has actually narrowed slightly, which by every rule that had held for 20 years should have made the yen stronger. Instead, the yen fell about 15%. In July, it touched 163.99 to the dollar, a 40-year low. So what is it following now? According to analysis from Lazard, what markets believe about Japanese inflation? A relationship about a third more sensitive than it used to be. Read that carefully because it is the whole story. The market stopped judging Japan on its interest rates. It started judging Japan on whether it can pay its debts. And that is a trap. Japan's inflation is imported. The war with Iran pushed oil up, and Japan buys almost all its energy abroad. Its oil import bill is up 59% in a year. Raising interest rates in Tokyo does not make oil cheaper in the Gulf. It just raises the interest bill on the largest debt in the developed world. Japan has tried to defend the currency directly. Over April and May, it spent 11.7 trillion yen, about $73 billion. A record. That is roughly 1/7 of Vietnam's entire economy, spent in 6 weeks. 6 weeks later, the yen was back through the level they'd spent it defending. They tried again on the 30th of July. The yen jumped 3% in about an hour. By the next afternoon, it had given almost all of it back. But here is the thing that actually matters. While everyone was watching the currency, the machine reversed. According to TD Economics, a Japanese investor can now earn about 2.3% at home, against roughly 1.3% on an American government bond, once you've paid to lock in the exchange rate. For 30 years, Japanese pension funds and insurers sent money abroad because at home they were paid nothing. That is no longer true. The pipe runs backwards, and that's the case for alarm. Here's the case against it, and it's stronger than you'd think. Start with the obvious objection. The gap might not close at all. It might widen. When America's central bank met in July, it held rates. But 3 officials voted to raise instead, the first time since 2016 that 3 have pushed the same way. Chair Kevin Walsh's summary of the meeting was, "I asked for a good family fight and I got one. If America raises while Japan crawls, this trade gets more profitable, not less." Second, Japan's debt has been called a crisis for 30 years and has never blown up. The IMF puts it at 204% of everything the country produces in a year, against about 126% for America and 65% for Germany, just over 2 years of national output. But it is owed in Japan's own currency, to Japan's own savers. That is why it has never broken. And third, be honest about the scale. $29.6 billion left America in the first 3 months of this year. Against a pile of $1.24 trillion, that's about 2%. A trickle, not a run. So here's what I'd actually watch. Not the exchange rate. That's the number everyone quotes, and it moves for a dozen reasons. Watch the gap between what a Japanese investor earns at home and what they earn in America once they've paid to lock in the exchange rate. And watch Japan's quarterly investment flows. Those two decide this argument. And what breaks first? Probably nothing in the way you're imagining. TD Economics estimates this dynamic could add between 1/5 and 1/2 of a percentage point to America's 10-year borrowing rate. That sounds small. It isn't. That rate sets American mortgages. It sets what companies pay to borrow. It's the number that every technology valuation is quietly discounted against. And it moves without anyone announcing anything, without a vote, without a headline that says, "Yen carry trade." That's the thing worth sitting with. For 30 years, the world enjoyed a subsidy nobody agreed to and nobody counted. The cheapest money on earth, flowing out of one aging country into everyone else's markets. That subsidy is being withdrawn. Not dramatically, not all at once, but steadily and in a direction that hasn't reversed in a generation. The crash in 2024 happened over a rounding error when the machine was still running forwards. It's running backwards now, which means the next one, if it comes, won't look like the last one. Here's my question for you. Does an economy that borrowed cheap for 30 years ever really find out what things cost? Until the lender stops lending? Next time we'll look at the debt itself, whether Japan's 200% is survivable at all. That's the global economy in focus. I'll see you in the next one.